Zehrid, I want to know what are the key risks you see in the US stock market at the moment and how you're trying to mitigate against them?
It's a good question. So on the economic side, clearly the uncertainty on the economic recovery is one area of risk. US elections is the other one, given that that will then dictate economic policies and whether the recovery does follow through and to what extent. Both candidates offer some sizable infrastructure spend as a way of stimulating the economy. Biden has got a more front-loaded plan, and therefore there could be more momentum there, but there's also some less business-friendly initiatives, notably on the tax front and also on the minimum wage front. So those are the risks on the macro side and the policy side. In terms of the corporate tax, clearly that could be a negative impact for all corporates. And that's something we've incorporated in our forecasts. Actually, we've decided that given the magnitude of the fiscal spend that is being pledged, that will likely lead to increased tax rates. And therefore, we've anticipated them through putting them into our models. The low rates environment is another potential challenge for investors generally. And the search for yield as a result will be an important aspect to consider for investors. So something that the Fed has very clearly messaged that those low rates are going to be there for extended periods of time. Therefore, there will be implications in terms of the search for yield, the attraction of the equity market itself in terms of earnings yield relative to the bond yields will be an important aspect. So there are risks, but there's also some support being provided as we're also getting out of lockdown and as we're facing an economic recovery. So from our point of view, there's still quite a bit of uncertainty there. Shape of recovery is something that a lot of commentators are talking about. From our point of view, we don't see a return to full economic activity until at least 2022.
Right, yes. So Paul, thinking about what Zehrid just said, what are the key risks you see in the US stock market at the moment, and how are you trying to mitigate against them?
Well, look, I think as always, there are always numerous risks, but I think at the present time, the biggest risk the markets face, in my view, relates to the economy and corporate earnings. We've seen a recovery which I think has defied the bearish expectations so far, but we've clearly got a long way still to go to recover lost output. We've had consistent beats to economic expectations, earnings expectations in recent months from a very low base. And it looks like we should be heading back to earnings growth in 2021, which is obviously a positive. Whether that happens or not will partly, I think, be driven by government policy, which in turn comes back to the virus, one of the biggest risks facing markets right now. The economic downturn was really caused by choices made by governments which were intended to protect health of citizens. So I think the positive aspect of that is that we didn't come into the recession with very large financial imbalances, which maybe means that the hangover will be shorter this time than post-global financial crisis. But clearly, if governments do decide to impose more lockdowns, that'd be terrible news for the economy and for corporate earnings, and indeed for stock markets more broadly. And if earnings don't come through, then valuations in US equities, which look relatively high, will not be supported, and markets are going to be at risk. And part of that risk in the US market, frankly, has been the dominance in terms of a small number of stocks within the market that have had very superior earnings growth, but are now obviously pushing on to high levels of valuation. So I do think we need to acknowledge this point on US valuations. It is a concern. You can have great companies, but the price you pay for a stock does matter at some point, and the leaders are pushing on to expensive valuations. That said, my personal view is that the environment is still fundamentally constructive for secular growth, winners taking an ever larger share across and within sectors, and that policy, importantly, is supportive for valuations as well. So I don't have a strong view we've reached a critical point where markets are going to collapse under their own weight from valuations, but that is a risk that we will ultimately reach that point of outright excess. Very briefly, just in terms of mitigating risks, first, I do think it does help to have a long-term perspective, because there are always short-term risks and there's always short-term noise. Practically, though, diversification, in our view, makes sense. Don't bet the ranch on one particular outcome. Obviously, express views on the portfolio, but excessive concentration for the end investor, I think, is a double-edged sword. We do run a range of concentrated strategies as part of FCIT in order that we add returns while reducing risk for investors.
Yeah, I think that diversification argument is very reassuring for investors listening at the moment. But I have to say, Paul, I think there's quite a lot of optimism coming from you there. And it's good to see some surprises on the upside. We always think of the US as the land of opportunity, the land of enterprise, and some of that seems to be coming through. Fran, what are the key risks you see in the US stock market, and how are you trying to mitigate against them?
You know, and I think we've spoken to some of them, but I think, you know, what we're looking at now is a lot of the stimulus packages, specifically the fiscal stimulus, has really propped up the consumer in terms of an unemployment safety net, as far as other means to help that consumer. And there's also a lot of stimulus targeted at small business, which has helped them survive, you know, through this period. As these programs begin to lapse, you know, we need a second round of stimulus. And I think that the important, you know, trade-off here is it's done properly and prudently, but yet it has to be done and it can't be caught up in politics, which right now it arguably is. So I think in the near term, that's a risk that we look at. I think when we look at more of the intermediate term, which is really important to us, it's, does this event weaken balance sheets? Does this enter a period of underinvestment? And we really need to be on top of our corporates to make sure that you know, they have the wherewithal and the financial wherewithal to get through this, and they're not cutting corners, they're not burning furniture to pay for the bills here, but they're properly investing, they're strengthening the balance sheet. And I think that those are sort of the key risks we look at, you know, and simply put, you know, diversification still matters, and buying, you know, good companies at fair prices at the end of the day is a winning formula, we think.